Hi ladies and gentlemen, welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Good day to you and welcome to this CPD learning activity in which we're going to be having a look at section 19 of the IFRS for SMEs dealing with business combinations and goodwill. My name is Anton van Wyk and I will be presenting this session. There's some background about myself if you're interested in reading that. And then I'd like to look at the agenda points that we intend to cover in this webinar. So as I said before, section 19, business combinations and obviously the resulting goodwill as per the IFRS for SMEs. So firstly, I want to just again give you an introduction to section 19 and the scope of that particular section of the IFRS for SMEs. Then we need to just have a look at the definition of what is a business combination, because we get various types of business combinations and we need to make sure that the business combination that we're looking at actually falls within the scope of section 19 of the IFRS for SMEs. Then we'll look at how is a business combination accounted for, and that's the real reason that we're here. So there are several aspects that one has to keep in mind when looking at the accounting treatment specifically of a business combination. So we'll investigate those. What the disclosures are that are required by section 19 to be made in the notes to the financial statements of an SME. And then lastly, I think it is always beneficial to just keep your eye on the bigger picture. And that's why I'd like to just do a quick comparison between the IFRS for SMEs and full IFRS. All right, so let's dig in and start with this, the first aspects of section 19. An introduction to the actual section 19 and a look at the scope of section 19. All right, so as you know by now, section 19 deals with business combinations and goodwill. So in terms of the scope of section 19, all business combinations that satisfy the definition of a business combination will fall inside the scope of section 19 with certain specific exclusions that we just have to bring to your attention. Then the section in IFRS for SMEs also deals with what is a business combination, providing a definition and some important aspects to remember. Then we're going to be looking at how a business combination is accounted for, and we do this particularly with reference to what is called the purchase method. And it's important to realize that there's only one acceptable method that can be used to account for business combination transactions, and that is the purchase method. And that contains certain steps that one has to follow. For example, identifying the acquirer. How do we know who the acquirer is? And the standard is quite strict. There must be an acquirer, because the acquirer is the party that obtains control and must therefore, apply section 19 of the IFRS for SMEs. Then how do we actually determine the cost price of a business combination? Now, you'll understand that this is quite important because we're going to be comparing the cost price of a business combination transaction to the net asset value that you obtained. Now, net asset value equals equity. So whether you look at the equity side or whether you actually look at the assets and the liabilities, that doesn't matter. When you compare the cost price of the business combination to the fairly stated net asset value or fairly stated equity of an entity, then the difference obviously is going to be kicking out as goodwill or gain from a bargain purchase. All right, so we'll have a look at all of that. Then the allocation, and I would say step 3 is probably the most important aspect of the purchase method, and that is allocating the cost to the assets, liabilities, and contingent liabilities of the acquiree. So we are going to have to find a method to determine this cost price. How do we allocate this to assets, liabilities, and contingent liabilities at the acquisition date? And then that is how we're going to be determining the amount of goodwill or gain from a bargain purchase, etc. All right, and then step number 4, I would like us to also look at recognition of contingent liabilities, and you can also add in there certain intangible assets, because Section 19 allows you to recognize intangible assets that would have under normal circumstances not be recognized in terms of the section dealing with intangible assets in the IFRS for SMEs. The reason for this being, and this is a pervasive consideration, we have to take into account that the downside of not recognizing assets and liabilities is that we're going to be ending up recognizing the purchase difference as either goodwill or gain from a bargain purchase. So the standard, the IFRS for SMEs follows the approach that if we allow more actual assets and liabilities to be recognized at the acquisition date, we're going to be left with more sensible information. And that is why you will see the concept of fair value measurement at the acquisition date allows us to recognize assets and liabilities at the acquisition date at their fair value. And that means that fair value incorporates probability. So when you want to recognize or measure rather the fair value of an asset or a liability, you're going to incorporate the probability percentage that cash flows will either flow in or cash flows will either flow out, regarding these assets and liabilities, and obviously depending on whether it is an asset or a liability. And that probability, which could be 21% or it could be 70% or whatever, is going to be factored into the fair value of the assets and liabilities at the acquisition date. So what is interesting is that fair value measurement actually embodies this concept that not many people realize, and that is that the fair value measurement almost, I want to say it in inverted commas, overrides the probability recognition criterion. Because when you look at normal recognition of assets and liabilities, you have 2 recognition criteria. Firstly, the future cash flows or the future economic benefit inflows or outflows must be probable. That means more likely than not to take place. And secondly, the asset must have a cost or a value and liability that can be reliably measured. So we're always looking at probability and reliable measurement before we recognize assets and liabilities. But now, seeing that Section 19 requires initial measurement at fair value, that allows us to actually look at those elements that fell under 50% probability as such. So if you felt that something was not more likely than not to occur, for example, and I know that this is very difficult to calculate, but hypothetically, let's say one was able to say that there's a 40% probability that this asset will generate future economic benefits. Under normal circumstances, we would not have recognized that asset at all because we required there to be probable future economic benefits, which means, hypothetically, because I know you cannot attach a mathematical value to this, but 50% or more probability. Otherwise, it wouldn't be more likely than not. All right. So now that we have a 40% probability, assuming that such a percentage can be calculated, that asset will not be recognized because it's less than 50% probable that future economic benefits will flow in. But now we get to a business combination. And now all these assets that are less than probable in the individual books of the entities now get a second chance at recognition. Because what enables that is that these assets and liabilities are now measured at their fair values. And fair value incorporates the probability percentage. So if we say that there is R1 million cash flow and there's a 40% chance, under normal circumstances, we're going to say we'll recognize 0. And if it were 55% probable, we would have recognized R1 million. So it is a bit of an all or nothing approach in respect of assets and liability recognition under normal circumstances.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.